Sandeep Bhatia joins us, represents Kotak Institutional Equities. Sandeep, morning. Thank you for joining us at Kotak Securities. What are you telling your clients? Is budget history now and time to move on?
Yeah, I think budget is definitely history. Budget was history, by the afternoon it was presented. Anyway, I think the issues that have faced India have not changed because of the budget. The good thing about the budget is that it's not made things worse. It is also a testimony of how low expectations are from the government, that all we expect is that let it not spoil anything further. So to that extent, that's fine. I think investors are basically looking to see if the market settle down and we see some policy actions such as fuel price increases after the budget session. So if those things happen, then that would be a positive signal from the government.
Sandeep, hi, morning. What is your sense of what foreign investors actually took away from the budget? Do you think there were any big disappointments? Because, we're still, for the last two trading sessions, seeing actually FII inflows kicking in and DIIs have been sellers. Or do you think another round of quantitative easing and we would get our share of money in any case?
Yeah, I think as long as the growth is in the region of 6.5–7% and expectations are that it will remain there, we'll get a share of money. As far as what investors take from the budget, the people who have been looking in India for, let's say, more than a decade did not expect anything because the political circumstances are not favorable to make any big pronouncements or announcements. So those were fine. Those were not disappointed. The others who thought that you would see tackling of subsidies and so on in a budgetary statement thought that this was lacking in any punch, but we had to educate them that this was not really the place, if at all, to do anything.
Right, Sandeep. Now that much of the event flow is behind us, Union Budget has been tabled, Eco Survey is over, and Reserve Bank of India has communicated their rate policy stance. What to your mind could be the next big trigger for our markets?
Well, I don't see any big trigger in terms of news flow or events for these markets. Then, it's just driven by external events. I think the crude oil prices and the inflow of money are the two big triggers to these markets. As far as earnings growth is concerned, I think we are in the process of ensuring that we don't fall further in terms of earnings growth trajectory. And, just waiting to see what is the pace of the interest rate cuts coming in from the RBI and domestically. Other than these three events, two of them external, crude oil and inflows, and only one internal, which is the RBI cutting rates. There are not much triggers left to this market. So mostly, as everyone expects, the market should be range bound.
I was just coming to that point, Sandeep. You talked about the central bank. Do you think this year they're going to start cutting rates aggressively, or do you think it is going to be a more muted response considering the high level of government borrowing?
No, I think we have been in enough indications coming from the RBI that they think there's suppressed inflation in the system. While the bias is towards rate cuts, we think it will be much more measured. In the best case outcome, I think there will be a 100 basis point cut all through this year. So 25 basis points every quarter for the next 4 quarters. So I don't think there will be any big accelerated cuts. It's inability to pass on fuel prices and the high crude oil prices make RBI's room for maneuver very limited.
Right. So, Sandeep, as of now, markets are sitting, or they made this assumption that a fuel price hike is around the corner. But because of political compulsions, if we don't get a fuel price hike in the next 10–15 days, will that spook the markets?
Yeah, of course. I mean, it will just raise the whole specter of not meeting the already high fiscal deficit number which has been budgeted. So, do we want to go back to the days where we again, get the next year's number close to the 5.9 that we just ended last year with? So, it's a choice that the government will have to make, and the government and the market will surely get spooked. I mean, most people expected straight after the election results came on 6th of March that we would see a fuel price hike, and then suddenly we will realize, we are going into a parliamentary session, so we can't do any work. So that's the way these things operate. So let's see whether in the first week of April we see any changes in fuel prices.
Sandeep, what if internationally oil prices were to escalate another $20 to a barrel from here to around 140, 150 odd, given the kind of geopolitical tensions that we are seeing in the Middle East as well? Do you think that could spook the markets even further and we could see December lows, or do you think that's not a possibility?
No, No, depending upon what are the circumstances exactly of this scenario that you have just outlined, the market will definitely get spooked, and from here on, at least 10 to 15% downsides are possible in that specific scenario that you outlined. And yes, I mean, if that happens and if the high oil price persists for more than a couple of months in the region of 140 plus, we can hit new lows. But, that's a specific scenario, and we'll have to look at the details of that before we make a pronouncement. But that's not definitely not the base case for anybody in this market right now.
What about the upside then, Sandeep? Do you think it is going to be a grind from 5,200 to about 5,600 for the better part up until the next big trigger comes in and the market moves forward? Or do you think after the kind of lows that we are seeing, once we are done with digesting what came about from the budget, the market is going to see a vertical notch up?
No, for the market to see vertical notch up, there has to be significant earnings upgrades. And, there is no basis to see that significant earnings upgrades are coming through. The only thing which has changed from December to now is the fact that liquidity has poured in. Okay, so let's not, kid ourselves by saying there's something fundamentally changed in the way we did things. We also all know that, last year we were the worst performing markets, both in terms of absolute falls and also in terms of the rupee pressure. So in dollar terms, we took a further hit. So coming from the lows of December, we had a notch up. We also got inflows, so we all look better right now. Other than that, there's no reason for the market to see a notch up. Fundamentally, it's very difficult to justify unless things change externally. We get a more benign crude price, or we see some movement coming through in terms of government policy action, at least on some burning issues such as fuel price subsidies. So other than that, it's just going to be a range-bound market. I would say that it's like capped at 5,500 Nifty.
So how does one invest in this kind of a market? One side you've got the fundamental turf, which is weak. There are mounting macro concerns on a daily basis, and despite these mounting macro concerns, markets are moving up because of liquidity.
Well, I think the only way to be sensible in this is to put your money in safe businesses. We like the tech sector. Tech sector has taken a lot of beating. It is a beneficiary from the rebounding growth in the U.S. Rupee will remain, in our view, rupee will have a downward bias. It will depreciate through the year because of the high crude oil prices. So I think probably tech is a safe sector to that extent. I think banks is something to look at, especially if rates are coming at some pace, maybe not very accelerated, but we would see moderate rate cuts coming through in the next 12 months. So those are some of the two sectors where we remain invested.
And outside the Nifty 50 or outside the Sensex 30, where do you see stock-specific opportunities?
No, I would be very careful to jump into mid-cap stocks. Mid-cap stocks are probably when we have a rebounding GDP growth. Our own estimate of GDP growth for next year is 6.7%, which is not very different from what we did last year for March 12. So clearly we have a moderate growth scenario. So to that extent, I would confine myself to larger cap stocks.
Sandeep, post the budget, what is your stance on infrastructure and banks, and how are you approaching these sectors?
Banks we remain positive on. It's one of the largest sectors in the market, and you cannot construct a portfolio without being overweight in banks if you are underweight in some of the other more high beta names. As far as infrastructure is concerned, we don't see any change in the cash flow strains that the sector has faced. We don't see any kind of changes in terms of the momentum coming from the government side, so we are underweight.
But is it banks across the board, or are you tilted towards PSUs or private banks?
We have a valuation bias, so we are tilted towards the cheaper PSU banks.
Sandeep, in the course of next 6 months, between liquidity, global growth and domestic growth, which feature do you think will surprise us on the upside?
And, your surprise is always contingent on what your expectations are. So before I answer the question, I have to basically delineate what my expectations are. Our expectations are that liquidity will be benign. Growth will be moderate at around 6.7 to 7%. What's the third factor you mentioned? Interest rates.
No, global growth.
So I think global growth cannot have a major, and surprise can be positive and negative. I don't know, you mean a positive surprise?
That's right. Just the way US economy has bounced back. I mean, when we started the year, who would have thought US unemployment rate would be at 8.5%, and Apple will appreciate by 45% this year?
So I think given we have low expectations of domestic growth, then that's where the most upside in terms of positive surprise lies.
So broadly, what exactly are you communicating to your clients? Should they sit on cash? Should they sell this market down on every uptick? Or right now, since liquidity is so strong, don't think about selling. It's time to remain. It's time to stay fully invested.
We are telling our clients to basically, if there's a rally in this market of in the region of 10%, to book their profits right now. And it's very difficult to pinpoint where liquidity will remain or go away. So to that extent, basically to book profits, we see a rise in markets over 10%.